All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. As always, I'm joined with Renji Matthew. And on today's podcast, we're going to be talking about knowing your numbers and preparing for retirement. It's crazy to me how many people I talk to that have no idea what retirement that they want to have or what's even possible. And a lot of the times, I would say, Renji, most people think that you don't need to have as much saved up as you need to have inside of your 401k to try to live the retirement that you want, right? So that's what we're going to talk about today is what is actually required to have the retirement of your dreams that you want to have and how to make that happen. So, and Renji, this kind of comes from a video that we were watching pre-show, and you actually filmed a TikTok about it to post, and kind of take us through that video and what they talk about with having like $2 million saved up and what that means.
Yeah, in that video, they talk about how you got to have $2 million to live comfortably, or comfortable retirement with the income you're taking out of that. So they break down if you had $2 million by the time you're 65 years old, how much you would have been having to save at certain years, right? So if you started at 25, this is how much you would have to save to get to 2 million by 65. At 35, 45, 55. So they break that down, and which we'll also break down in this episode. And then we'll also talk about an alternative route to build income for retirement also. So yeah, I think go ahead and start breaking it down, Kyle.
Let's do it. So you can see my screen, right?
Mm-hmm.
Okay. So with this, like we said, inside of this TikTok clip, they say that you should have about $2 million saved up by the time you get to retirement to live a comfortable retirement. And now I've heard people say that that number is really, closer to like $3 million, which is crazy. So we went ahead and created a chart just to show you that based on the amount that you have saved, this is your yearly income estimates based on the 4% safe withdrawal rate. Financial planners for decades have used the 4% rule to plan how much you can withdraw safely from your assets so that you don't run out of money prior to your death. So you can see if you've saved up $300,000, 4% of that, your yearly income is going to be $12,000 a year. $1 million, which, for most people seems to be like a huge milestone. And that only gives you about $40,000 a year of income. To most people, they think it should be more than that, right? For $2 million, that would only give you about $80,000 a year in income. And then lastly, if you've saved up $3 million, that's an income of about $120,000 a year. So they go on to then show this slide, and it's talking about, okay, if you need to have, $2 million at 65 to have a comfortable retirement, here's what that looks like based on monthly savings and whatever age that you're at. So if you're 25, you would need to save $600 a month right now until the age of 65. So for 40 years. And that would get you to a retirement nest egg of $2 million for you to go and retire on. If you wait just 10 years and you start saving at 35, you're required to save $1,400 monthly to reach $2 million by 65. If you wait 10 more years until you're 45, it takes $3,500 a month. And then lastly, if you wait until you're 55 and you only have about 10 years to go, you're required to save over $130,000 a year to your retirement to reach 2 million, or that's $11,000 monthly. So you can see, obviously, the earlier that you start, the better, and the more obtainable that this goal is for most people, And with that, we've seen this path. Renji and I, being in the industry now for multiple years each, we've seen that the average American is reaching retirement and they only have, what would you say, Renji, $200,000 to $300,000 saved up?
Yeah, about between under 250 is what the average they're saying, between the ages of 65 to 74. That's how much they have when they get closer to retirement, which is sad.
They only have about 200 to 300,000. And if you see here, $300,000 saved up, you can safely withdraw $1,000 a month of income, right? And so knowing that and seeing that, Renji and I realized, but wait, what if I just bought one asset that can produce me $1,000 a month of profit after the expenses, right? $1,000 a month of profit can be had with just one rental property, right? Some may say that's aggressive for one rental property, but it can be close. It definitely can be. And $1,000 a month would be $12,000 a year of income. And that's just owning one asset. So owning that one asset is equivalent to having $300,000 saved up inside of something like a 401k or an IRA because it gives you the same income, right? So then the question really becomes, okay, how quickly can I get more assets, right? Or how many assets should I acquire to make sure I can be financially free and to live the retirement that I want or to live the lifestyle I want? You don't have to. Here's the crazy thing, especially as we go through this, you'll see this. This is why so many people get into real estate. It only takes 3 assets to give you, let's say in this example, $36,000 a year. And the income equivalent value, or the IEV, of owning 3 assets is like you having $900,000 saved up inside of a 401k. If you own just 7 assets, that's $84,000 a year of yearly income. That's like owning $2.1 million in income equivalent value. Like that's inside of a 401k, right? And then if you get to 10 assets, that's equivalent to having $3 million inside of a 401k, right? Not only is the income equivalent value obviously much simpler to build up your net worth and build up wealth by acquiring assets, but one of the things that we didn't even talk about on these slides is all the additional benefits. We're just strictly talking about monthly cash flow, but what are the additional benefits of owning assets? You have tax benefits like depreciation and just the deductions with the expenses that come from owning that business. You have an appreciation of property over time. You have the monthly cash flow, the monthly income, and then you have the ability to scale and to be able to borrow from your equity and take the equity from one house and use it to go buy another house if the asset class that you happen to choose was real estate. So with that, Renji, and you tell me if you want me to stop the share or keep it up or go back to any of the slides, but what do you want to add on to this? What am I missing?
Yeah, no, you you covered it perfectly. What I was thinking was, is it easier? So, what is traditional retirement route? They say work for 40 years and then retire off of 40% of your income, right? So, with that in mind, is it easier to build up to 1 million or 2 million in 40 years? Or is it easier to buy 3 to 7 assets in those 40 years? Go back to that page up, the assets. Yeah. So in this slide, we see equivalent to having almost 1 million, which is 40K a year. When you go off of that 4%, is having 3 assets. Do you think you can buy 3 assets in 40 years? Right? It's so many more tax benefits too, and not only that. Let's say you retired for 20 years after you became 65, and you made passive income off of those properties for 20 years, and then you decide you want to sell it. You're going to make more profit on that. You can't do the same with a 401k. You can't take income and then sell a 401k to somebody else. If that was a possible thing, you wouldn't be selling it for the same amount you started, right? With the real estate or any asset, those values appreciate over time, right? And you could sell it for way more than what you bought it at 10, 20 years before. So that's the thing is we don't ask what age I need to retire. We ask how many assets can we acquire, right? So what are your numbers when it comes to, if you're wanting to go the traditional route, you want to know what your numbers are to retire. How much income do you need monthly to retire? Same way, if you're going the assets route, how many assets do I need to make that same amount of income every month? And in both ways, you gotta think about both of them are hard, right? Now you got to choose which hard which path you want to go down, which hard can you handle, right? Because if you work for 40 years and you retire off of 1 million where you're making 40,000, and again, that 4% safe withdrawal rate is a standard rate that they go off of. But right now, if actual safe withdrawal rate, depending on the market, it's less than 3%. I think last time I looked, This was 2 months ago or something. It was about less than 3%. So that's another thing. By the time you retire, if all you're doing is traditional retirement plans, do you know where your tax rates will be? First off, do you know how many write-offs you have? Another, because most people, as of right now, let's say they're working, they have kids, they might have a mortgage. Those are all write-offs, right? Those are all deductions. Most people, when they retire, they don't have a mortgage anymore. Most people, when they retire, they're empty nesters, no more kids to deduct. So there's less money that they can deduct. So in the eyes of the IRS, hey, you have more money to, tax. And not only that, we talk about how taxes could go up because of our national debt. So if you keep deferring your retirement income in deferred accounts, you might be paying a lot higher in taxes in the future. But when you buy assets, those are only going to appreciate in value, right? So let's say you took the income for 10, 20 years. Now, when you sell it, you're going to make way more money than what you bought, the money you spend on those properties. So think about which path you want to go and which one is easier or harder for you to do. Like I said, can you get 3 properties that will cash flow you in 40 years? If so, if you looked at the IEV, you've saved up enough for equivalents of what $1 million account would pay you annually. I think that's all. And again, you guys saw the numbers, and the reason it's better, the earlier you start, the better. Even if you're going down the assets route or putting money into 401ks or IRAs or whatever it is, the earlier you start, the better, because you can start with a lot less.
For
That's
sure.
all I want to say.
Yeah. And this, I mean, these two paths are like the clear difference behind what it means to build wealth versus like just getting rich. Building wealth is owning assets and owning multiple and being able to scale it. Getting rich can come from, simply just having worked for 40 years, saved for 40 years, invested for 40 years, and you've got, $2 million inside of a 401k. But that's only going to give you, like we said, about $80,000 a year of income. This is why we talk so much on our podcast and also inside of our school community about why it's important to, number one, know and understand how money works, but then also number two, to make your money work harder for you than you work for it. And how do you do that? You put your money to work. You buy assets, you borrow from the assets to buy more assets, and then eventually we die and we have life insurance that pays for all the assets and transfers wealth tax free. This is what the wealthy do. This is what they have done for hundreds of years. And for some reason, this stuff just isn't taught to us in high school, not taught to us in college. Our parents didn't know, our grandparents didn't know. So it's up to us to educate ourselves and to know the benefits that come from owning assets and owning businesses, owning real assets and real businesses. And these are just some of the things that we talk about. And we kind of started the conversation about knowing your numbers and then pivoted to, you should be owning assets instead of just investing into 401ks and IRAs for retirement. But at the same time, I mean, I think for what we believe in so strongly is getting into assets. I think that almost every conversation we have, that's where it eventually goes to. Why
Yeah, and not
save
to
a bunch of money
say,
into a 401k when it's going to be taxed
yeah,
later? You're going to have less income and you can't touch it until you're 60 anyways. Go ahead.
and not to say that's you don't have, if you're going that path of working and retire saving for retirement in a 401k and stuff, there's nothing wrong with that. If that's your path you choose, kudos to you. We just talking about 2 different ways you could do it, right? Because with going that path, something that came to mind, I read this quote the other day, and I don't know if it was a quote or just a meme or what I saw, but they said, rich is having money, but wealth is having time and money, right? So there's executives that work at high paying income jobs that make millions in a year, but they don't have any time. They're working 50, 60 hours a week. Then there's people that buy assets, and they're making a lot less, but they have so much more time with family. Because why are you working so hard for anyways? Isn't it time for to provide for your family? Isn't it to live a lifestyle that you want to. But if you're working all that time, making all this money, but you can't spend it on your family or use it to do what you want, is it really giving you freedom? So there's a difference between being rich and being wealthy. So that quote to me makes so much sense. Being rich can mean you have so much money, but being wealthy means you not only have money, but you also have time, the freedom of having both.
Absolutely. And with that, I think that's a good way to kind of start, wrapping up this show. If you guys want to learn more about how to build wealth, we put together a whole school community that talks about the 6 money markers that you have to hit on your way to reaching those milestones. And we go into depth. We have like 3 to 4 hours, I think, of content filmed that's inside of that. And that could be found. We'll put the link below in the description. And as always, be sure to tune into our next episode. Like, comment, and subscribe. If you guys have any questions or if there's anything in particular you want us to cover, drop that in the comments below. We do read our comments and have used some of your comments in the past to spark new ideas that we can use for our future episodes, and we appreciate that. And so with that, hopefully you guys all have a great rest of your day, and we'll see you on the next episode. Take care.